Welcome to today's stock analysis, where we will analyze the two Dividend Kings, Abbott Laboratories and Abbvie Inc. Both companies have paid yearly increasing dividends to its shareholders for the last 52 years. Our focus in this video is on assessing the intrinsic valuations of these two Dividend Kings using 5 distinct models. If there's a particular stock you'd like us to analyze in an upcoming video, feel free to drop it in the comments section below, and it just might make it into our next analysis. And now, let's dive into the intricate world of stock analysis and discover what these insights reveal about today's stocks. Here, we've seamlessly integrated the ticker symbols for Abbott and Abbvie into our spreadsheet, automatically importing the relevant stock data. Examining the 365-day graph for both stocks, we observe fluctuating upwards trajectories for both stocks' valuations over the past year. Both Abbott and Abbvie have gained approximately 14 to 15% in their stock prices. Shifting our focus to valuations in comparison to target prices, Abbott appears to be approximately 11% below the mean analyst target price, signifying potential undervaluation. Conversely, Abbvie aligns more closely with its analyst target price with only a 2.5% difference. Both stocks exhibit an RSI around 40 to 60, indicating a balanced state with neither being oversold or overbought. As both stocks are Dividend Kings, many investors would be interested in the dividends. Taking a look at these, we can see that Abbott pays $2.12 in yearly dividends, which corresponds to a current yield of 1.87%. Abbvie pays a higher yearly dividend of $6.23, corresponding to a satisfying yield of 3.47%. Now, let's delve into a more detailed analysis of the intrinsic values for these two stocks, utilizing the 5 distinct intrinsic valuation models embedded in this spreadsheet. This exploration will provide a comprehensive understanding of Abbott and Abbvie's intrinsic valuations. Our initial stop in the realm of intrinsic valuation brings us to Graham's revised valuation model, a creation of the legendary Benjamin Graham. This model enables us to determine intrinsic value based on 3 key inputs: earnings per share, the anticipated growth of the company, and the current yield of a AAA bond. Fortunately, our automated spreadsheet streamlines the process, requiring only the addition of the company's projected growth, readily available on platforms like Yahoo Finance. Upon incorporating the projected growth for Abbott into this model, the intrinsic value calculation yields $51.93. Remarkably, this indicates that Abbott's intrinsic value is approximately 54% below its current stock price. Applying the same methodology to Abbvie, the intrinsic value computation results is only $74.64, revealing a similar difference of 58% relative to the current stock price. Moving on to the next valuation model, we explore the Peter Lynch Dividend Adjusted Fair Value Model. In this method, the Peter Lynch fair value is determined by adding the earnings growth rate and the dividend yield, and then dividing the result by the price-to-earnings ratio. The output is a value either above or below 1, where a value below 1 suggests an overvalued stock, while a value above 1 implies an undervalued stock. Upon applying this model to Abbott and Abbvie, both stocks exhibit a Peter Lynch fair value below 1, indicating that they are currently overvalued. To refine this assessment, we can transform the Peter Lynch fair value for each stock to the stock's corresponding intrinsic value. I won't delve into the specifics in this video, but if you are interested in the computations, I can refer you to our Peter Lynch fair value tutorial, where this is explained. For Abbott, this computation yields a fair stock price close to $40, falling below its current stock price. Abbvie's fair stock price is calculated to be $72, once again coming in lower than its current stock price. Now, let's delve into the comparable company analysis, also known as the multiples valuation model. This approach involves identifying companies similar to the one under scrutiny and utilizing their price-to-earnings ratios to calculate intrinsic value by multiplying with the company's earnings per share. In our analysis, I've included comparable companies for both Abbott and Abbvie. Focusing on Abbott, the intrinsic value derived from this model stands at $137, almost 23% above the current stock price. Shifting our attention to Abbvie, the calculated intrinsic value is $100, significantly below its current stock price. This comparison unveils interesting dynamics, suggesting that Abbott is currently trading at a valuation under its industry peers, while Abbvie is experiencing an overvaluation. Now, let's explore the dividend discount model, a method that delves into a company's dividend payouts over recent years. We calculate an average dividend growth rate, and this, along with the discount rate, is used to determine the intrinsic value of the stock. The spreadsheet also offers the flexibility to input a custom dividend growth rate, allowing for adjustments to be more conservative, if desired. As the stocks are both Dividend Kings, they pay out yearly increasing dividends. This allows us to use this model on the two stocks. For Abbott, we leverage the quarterly dividend information available on Yahoo Finance. By incorporating the quarterly payouts and setting the payout interval to quarterly, we obtain an average dividend growth rate of 11.66%. Looking at the dividend increases for the last 3 years, we find this to be too aggressive going forward. Therefore, we will use a more conservative custom dividend increase of 7%. Setting the dividend growth rate to custom and utilizing a discount rate of 8.5%, the calculated intrinsic value for Abbott comes in at $156.93. ABBVI also pays quarterly dividends, and when we add the quarterly payout for each year to the table, we obtain an average dividend growth rate of 7.72%. Again, using a bit more conservative custom dividend increase of 6% and utilizing a discount rate of 8.5%, the calculated intrinsic value for ABBVI comes in at $262.88. By using this valuation method, we find that the intrinsic values for both companies are above their current stock price, signaling a potential undervaluation for both stocks. Our final stop on this intrinsic value journey brings us to the discounted cash flow model. This model values a stock by estimating its future free cash flows, discounting them to present value using a chosen discount rate. It then factors in total debt, adds cash and cash equivalents, and divides the result by shares outstanding to determine the intrinsic stock value per share. For Abbott, we can source the necessary data from Yahoo Finance, including cash and cash equivalents, total debt, shares outstanding, and free cash flow data available online. When we integrate this data into the model, the intrinsic value calculated stands at $103. This is close to its current stock price with a 9% difference. On the other hand, applying the same methodology to ABBVI, the model yields an intrinsic value of $388, which is more than double of the current stock price. To look a bit further into this potential upside, we go to Simply Wall Street. This site also calculates the intrinsic value of a stock by using the discounted cash flow model. For ABBVI, we find an intrinsic value of $373.02, which is very close to the $387.98 from our calculation. These diverse intrinsic valuation models provide us with a comprehensive perspective on the intrinsic values of Abbott and ABBVI, offering valuable insights for investors seeking a deeper understanding of these stocks in the market. In the summary section, we've assessed and compiled all calculated intrinsic values for Abbott and ABBVI, making strategic decisions on which valuation models to include in the final calculation. Using the average intrinsic value for all 5 models, the mean intrinsic value for Abbott is $97.84, which is 13.5% below the current stock price. Acknowledging the inherent uncertainties, a margin of safety of 20% is incorporated, leading to an acceptable stock price of only $78.27. In the case of ABBVI, we also use all 5 valuation models, and the average intrinsic value is found to be $179.59. This is very close to the current stock price of $179.38. By applying a margin of safety, the final acceptable buying price hovers at $143.67, again below the current stock price. In conclusion, neither stock presents a clear-cut attractive buying opportunity. However, according to the calculations, ABBVI emerges as the more favorable option, considering that the difference between the current stock price and the calculated intrinsic value is the smallest. If you found value in this video, don't forget to hit the like button and subscribe. It truly goes a long way in supporting our small channel. And if you want to harness these valuation models yourself, check out the intrinsic valuation tool featured in this analysis, available exclusively on our Patreon page. There, you'll also find a comprehensive valuation list for all stocks analyzed on this channel. For your convenience, the link to the page is in the video description below. Happy investing! Now, a crucial disclaimer: I am not a professional financial advisor. The stock analysis presented on this YouTube channel is intended for informational purposes only and should not be construed as financial advice or a recommendation to buy or sell any stocks.